There was a fraud in the company. The management, of course, clarified yesterday, and the stock's up about 1% or so at this point in time. So yesterday, 3.25% recovery from the lows, and today another 1% in the pre-open. We'll address this once we have the market open itself.
Okay, well, looks like the market opening is going to be a positive one, right? We have 30 seconds left. There's a lot actually for the markets to latch on to. Inflation in India was lower than what the street was expecting. US inflation has cooled off. Bond yields have cooled off in the US. Crude prices are lower as well. There's been solid buying coming in from domestic institutional investors, and we've had a strong US markets ahead of the Fed rate decision. So the recipe is good. The cocktail is good for the markets to sort of build on to its gains. Let's see, any hint of dovish signals from the US Fed will be latched onto by the bulls. For now, market has started in the green, 20 points in the green, so just wait and watch mode perhaps ahead of the big event later in the evening. 20,900, 20,923, which is a gain of 20 points. The Sensex is up about 70 odd points as well, and the advanced decline ratio is well in the green as we speak. The big movers, Axis Bank is up almost 0.6%. So that is a big mover this morning. BPCL, we were talking about oil marketing companies, right, in pre-opening, that the fall in Brent crude prices is positive for them. So BPCL is up in the green. ITC, on the back of positive statements from the management, is up about 1%. NTPC, UPL, Tata Steel, Eicher Motors, all in the green right now. Hindalco, HUL and Wipro are a couple of other stocks. So what is dragging the markets this morning? ONGC, TCS, Apollo Hospitals, HDFC Life and Kotak Mahindra Bank, couple of stocks that are down about 0.5 to 1% or so. Now the market is trending a tad bit in the red. It's nothing alarming, just consolidating its gains. Some of these stocks like IRDA, etc., are just sort of catching their breath after the big rally that we've seen. But the broader market momentum continues, Nigel.
Well, that's right. So, quite a few stocks moving around out there. In terms of stocks that are moving up, IRDA continues to move up. Another big volume mover is SEPC. That one, I think, is doing a fundraise. So that one as well up close to 2%. One of the top volume movers out there. Karur Vysya Bank, that as well is up close to 2.8%. In a few minutes, close to 10 lakh shares getting traded already on that one. On the flip side, you have Bank of India. They had done a fundraise of late. The QIP, which is subscribed numerous times. I'm wondering whether there's some supply coming out there, because in the first minute itself, Bank of India is the one we're talking about. That's down close to around 6%. Massive volumes been seeing on that one. So we'll have to get a quick check on that one. Suntech, as the screen is telling you, well, we were expecting some kind of a block to take place, and that's precisely what's happened. So a large trade takes place. 4.5% equity changing hands at around 482 rupees a share. J&K Bank as well come in for some profit taking. And IRDA, after opening 3% up, that one's now down. Some kind of sanity actually prevailing, because that stock is corrected close to 5% from the morning tick itself. Prashant.
All right, well, it's 16 points lower, Nigel, on the index, 20,890. So neither here nor there, kind of a start. But as we were saying, maybe, there's, of course, the big Fed decision later tonight, which perhaps is responsible for some of this. Otherwise, overnight handoff, etc. Just if you look at the US market change, was positive. What else? Dixon started, I think, 3% higher, but like yesterday, Dixon is now flat. By close, Dixon had given up all of those gains and was flattish. PI, we already mentioned, 2.5 higher. Inox Green was a big mover yesterday. I think there is some initiation reports there from brokers. 4% higher on Inox Green. HPCL is up 2.5%. Karur Vysya is up about 2.25%. KPIT Tech is starting about 3% higher. Indigo starts about 2% in the green. Oil down sharply. Motilal Oswal Financial Services is up about 5%, 1,274. That's a large one. And I'm only mentioning things with large volumes for this point in the day. And I think Karnataka Bank is another one which starts up with decent-sized volumes and gains. Bank of India is down 6%, I think, as we mentioned. Stocks at about 109 rupees on Bank of India. So that's a large cut coming through. And Paytm is down 2.5%. It's already in the last 30, I think today is the 35th or the 36th session. It lost 40% of its value. The high was almost exactly $1,000. It's at 600 now in exactly 35 sessions. Suntech Realty, we mentioned. Adani Transmission is down 4%. It's coming up with large volumes. Adani Green is down another 2%. So some of the big gains, 30, 40, 50% gains that the Adani Group stock saw last week, mild givebacks. I mean, nothing very large at all. And Laurus Laboratories is down about 2% or so as well. So that's the overall picture. Market breadth is still negative, although the Nifty is down about 15, 16 points. Sonia.
Okay, so there is a lot that's happening in the market right now. So don't be fooled by the headline index, right? The headline index may be flat, but plenty of stocks are looking pretty good at the moment. IRDA is once again rallying, so 2.5% high on IRDA as we speak. A lot of stocks hitting fresh highs. NHPC is at a fresh high. PFC, Tata Power at fresh 52-week highs. REC, NBCC. Hotel stocks have started to come back in a big way. Mahesh Nandurkar, who is the India strategist at Jefferies, joins us now to talk more about the market and, of course, the way forward as well. Mahesh, thank you so much for joining us. And, season's greetings to you, your entire team at Jefferies. It's been a rollicking year for the market, right, so far. Do you think we have it in us to build on to these gains ahead of a big election year? And how are you positioned now in the index?
Hi, thank you for having me here. The market has had an excellent 2023 for sure. But I don't see any reason to be excessively pessimistic here, because if you look at several global factors as well as a lot of domestic factors, a lot of positivity around those factors, I would say. And I would say that yes, I mean there could be some minor pullbacks here and there, which cannot be ruled out. But if you take a view from the next 12 months or next 24 months, my sense is that we are in for a strong double-digit returns from the markets. Obviously, the composition of what goes up and what goes down will probably be slightly different. My key thesis is that what has necessarily worked in the last, say, 5 or 10 years, I'm talking about a slightly longer time frame, will not necessarily work in the next 5 or 10 years, but a lot of opportunities for long-term investors to take bets here and to profit out of it.
What are you hearing from foreigners, Mahesh? That's the big cohort which has stayed out. The market's gotten to where it has gotten without very much help from them.
Absolutely.
So far. Are they going to come back in a big way? What are you hearing?
Yeah, I think so, because right now what we're clearly seeing is that India is beginning to show up a lot on the on the radars of a lot of global investors, not just the typical Asian market investor or emerging market investors, but a lot of investors with global mandates. And rightfully so, because I think in about 3 years' time, India will be the 3rd largest GDP. We're already the 4th or the 5th largest market by the market cap terms. But clearly, if you look at some of the global indices, India's neutral weight is still below as compared to where it should be. But given the changes that are happening globally, especially the Chinese markets is no longer in a big favor at this point in time. And my sense is that you will see more inflows from the foreign investors as well. It's just that a lot of foreign investors are staying out at this point in time on the valuation concerns. But we have seen this several times in the past as well, and I think something similar will happen over the next 12 to 24 months. That this concerns about the valuations will slowly begin to be absorbed by the foreign investors as well. That's clearly the sense that we are getting.
All right, Mahesh, good to see you in our studio. Mahesh, one theme that has really played out is the PSU space. And you all have been positive on a couple of names out there. Coal India, NTPC. Now we're looking at the PSU basket and saying the market capitalization is 50 lakh crore. It has valuation support as well, if that is a parameter. Do you think it has more legs from here on? Last 18 months belong to some of these PSU names. The next 18 months as well, will they continue to remain the leaders?
Several PSU stocks are actually looking very reasonably valued, as you rightly said. And the market and the investors will be focusing on that part, the valuation part, much more. See, again, I'm taking a slightly longer term view. I mean, over the last 5 to 10 years, the way to make money in the market was ignore valuations and just stick with quality, just stick with predictability, and then you end up making money. But I think that has clearly changed given the fact that India's Capex story is unfolding, and clearly we are in a period where a lot of small and mid caps are actually outgrowing their larger peers by a wide margin, and clearly the focus has come on the valuation side. So come back to answer your question on the PSUs. I think a lot of these stocks are trading at attractive valuations, be it on the power side, utility side, power financiers, coal mining, and even some of the banking stocks as well. So I see plethora of opportunities in the PSU space.
Okay, plethora of opportunities in the PSU space. Your view echoes the sentiment that many experts have had in the recent past as well. We were speaking with Sridhar Shivaram a couple of days ago, and he said the best way to do it, perhaps, if you're struggling to find stocks, is go through some of the PSU mutual funds, right? There are a couple of good ones out there as well. All right, you have a very high conviction in the Capex plays, and in the broader market, some of the stocks that you've liked are names like Polycab, KEI, Kajaria Ceramics, Thermax. These are, of course, great names, but the rally has also been stupendous here. If someone has missed out on this theme entirely, is there still more scope?
Definitely. And I'll just give you my personal example here. I used to be a consumer staples analyst about 12, 15 years ago. And most of the stocks in that space used to trade at 20 times P multiple, some of the large cap names. And when I would pitch those stocks to several investors, they would say, 20 times P multiple for a company that is growing its earnings by 12, 13%, I'm not paying that much. And what has happened over the last 10 years is that 20 became 30, 40, 50, 60, 70, right? So the definition of what is cheap and what is expensive has changed materially over the last 10 to 15 years. And that does happen when some of the key themes emerge. So as I said, last 10 years, the theme was stick to quality, stick to predictability, ignore valuations, and those stocks have really risen from 20 times to 70 times. Some of the names on the Capex side that you mentioned have got re-rated already. And because we have this tendency of comparing everything with what has happened in the last 5 years, and you'll see, oh, these stocks are trading well above their last 5-year averages. But I think the market will come to terms with it, in my view. And given the strong earnings growth that many of these companies will be delivering over the next several years, and even if there is no further re-rating, the earnings growth alone should drive 15-20% plus returns from here on in many of these stocks.
In large part, it's also a function of just too much money, right, coming into equities as an asset class. I mean, isn't that a big part of it?
It is, absolutely. So you cannot really ignore that. And as you rightly mentioned in the beginning, most of the market rally or movement that we've seen so far has been driven by domestic investors, and foreign investors have largely stayed out. But I think the sense that we get is a lot of investors have also been on the sidelines, as I said, one, because of valuations, and secondly, also because of upcoming the political events. And there is some element of uncertainty in the minds of a lot of global investors that have not participated in India so far. So while the consensus is pointing towards one thing, but many global investors still want to take a bit of a pause. But I think, as I said, both these
still pause because of the political
uncertainties, and they want to have kind of see the final outcome.
So these are based on what you're telling us is this is based on the conversations after the election results. I mean, after,
before, generally over a period of time.
There's a big difference, Mahesh, right? I mean, before that weekend and after that weekend, because of the results that we got.
No, that's why the market moved up the way it did.
Yeah.
But it's not necessarily that the same global investors that we are talking about we have seen some flows coming in, but I think still I see that there are a lot of foreign money sitting on the sidelines. And so therefore I mentioned that while there could be some pullbacks, but those pullbacks will be short-lived because there's a lot of foreign money waiting on the sidelines. So those dips will get bought into.
Well, Mahesh, China +1, Russia +1, India is gaining. In a few years, I think we'll be saying India is the only one. That will be pretty good for us as well. And we've discussed a few themes actually in this conversation. But, and on select themes, well, some are bulls, some are bears. But the one that you all have been quite bullish on, which has not been really a consensus call, has been Honasa or Mamaearth. And kudos to your analysts as well. Came out with a note when I think the stock was down 15 or 20%, if I remember correctly. Some of these names, do you still believe, even at these valuations, there's plenty of value still remaining on the table?
Yeah, so, as I said, I cannot comment on specific stocks, but I definitely believe that there is, a lot of opportunities in many stocks. I mean, I think banking sector is one name which has lagged quite a lot over the last, 1.5 years. We see value there. We discussed PSU stocks already. I think there are a lot of names on the Capex space that we like, and despite the re-rating that we've seen, can see meaningful upside even from here on. I would say the same thing about real estate side as well. Consumer side, I believe that one will have to be really, really selective.
Okay.
And, one cannot just stay overweight on the broader consumption basket of stocks. and expect to outperform. I don't think that's likely in my view. So one will need to be very, very selective, in that space.
Okay. All right. I have 2 little kids at home, so I know about the brand, but the valuations, I think your analysts are best placed on that one. Just one quick word on the banking space. If they're going to do well from here on, and given the kind of part re-rating we have seen in PSU names, what would your preference be, private or public sector banks at current reckoning?
I think even the private sector banks are now looking very attractive on valuation.
Okay.
So some of the large cap banks, I would say the large cap banks, I would say broadly speaking, the banking sector as a whole is the only sector which is trading below its historical averages, and including some of the large cap names, which I think can be great compounding stories. Yes, some of the PSU banks can be outperformers, some of the smaller private banks can be outperformers, but even the large private banks, I think, will be very strong compounding stories from here on.
Okay. One of the areas you've been very bullish on is real estate, Mahesh, right? For a long time. Are you still gung-ho?
Oh, absolutely. Absolutely, for sure. I think we are in the 3rd year of the property market upcycle, and I think it's a cycle that will last for 8 to 10 years. So we have a long runway for the property stocks to deliver.
And stocks are capturing how much? Like 3 years out or 4 years out, what are they capturing? As broadly, some of the leaders which have done well. How much is in the price is the question? Or you think there's a lot of money to be made here?
I think you will probably see surprises coming up on the volume growth side and broadly the earnings growth side as well. And one of the big misconceptions about the real estate sector is that because of the accounting policies that they follow, the stocks move on the back of pre-sales, but by the time those pre-sales reflect in the revenues and and earnings, it's like 4 years out, because the developers follow this project completion method. So recognize revenues and profits when the projects are completed and handed over. That's like 4-5 years down the line. So seemingly the stocks appear expensive if you look at near-term P multiple or EV by EBITDA multiple, but actually they are not. Okay. So I think, strong runway ahead for the next 3 to 4 years.
I just have to ask you about this one sector. So I'm really excited about this whole green energy transition, right? I don't know if you share my excitement, but just look at that. Adani Group, for example, is investing $100 billion in this green energy transition. And so many renewable energy stocks, whether it's Startup Power, Inox Wind, all GSW Energy, all doing well. But for someone who is still looking to partake in this move, is it worth their while?
I think green energy, and I would say in the same breath, the traditional energy as well. Because what we are seeing is that the power sector as a whole is a space that the economy or the country as a whole has underinvested in the last 4-5 years. And we are looking at the power sector utilization rates moving beyond 80%, something that we've never ever seen in the history of the power sector. So there is going to be strong returns in the traditional energy side as well as the green side as well, I believe.
All right, Mahesh, we'll leave it there. Thank you very much for joining us. It's a pleasure having you with us here.
Thank you very much for having me here. Thank you. Thank you.
Well, I think we've got the market, which is down, 2 points or so. So there's not very much going on here at all. We're at about 20,900. So blinking red and green, literally, but with market breadth, which is looking pretty strong. Nigel, we've got the next management with us.
Well, let's get straight to the next management then. We're looking at Manappuram Finance in today's trading session. And in fact, that one has been in focus. The street is a little bit, they want to understand what kind of loan growth are they looking at, as well as what's going to be the split between gold as well as non-gold. We have Mr. Nandakumar, the Managing Director and the Chief Executive Officer of the company, who joins us on the show. Hi, Mr. Nandakumar. Thanks so much for joining in. Well, tell us, what kind of a growth outlook do you have for us? For FY24, FY25, what kind of growth are you looking at on the AUM front? And also split it up for us in terms of a mix. How much of it is going to be gold and how much of it is going to be non-gold?
So, as we have told in the past, we are on the track of a growth of around 20% on the consolidated book. We are growing non-gold also, non-gold particularly MSME, car finance, commercial vehicle finance. These secured business we are growing. At the same time, our Ashirwad microfinance, our the subsidiary, that is also growing in a robust manner. So gold is this quarter it is flat. So, but why it is flat? Because there were many festivals during this quarter. That could be the reason, because of redemptions were relatively higher as used to. So we expect around 7 to 8% growth in gold also during the current fiscal. So overall, we are 20%.
Consolidated at 20%, Mr. Nandakumar, and gold should grow by 7-8%. Okay, we got that. But what does gold as a percentage of a mix come down to? What will be the ideal mix for you?
So as we have been telling for some time, the ideal mix what we intend to have is 50-50. 50% gold, 50% non-gold. So that all with the gold also we are promoting the secured the loan growth like commercial vehicles, car, and MSME as the major growth drivers going forward.
Okay. Mr. Nandakumar, hi, good morning. The RBI recently stepped in and said they asked banks and financial institutions to raise risk weights on unsecured lending. In an indirect way, do you expect more competition from banks in the gold segment because of this, because they'll have to go easy in other segments? Competition from banks in any case over the last couple of years has been a concern. Do you think this will increase it?
So competition will always be there, but the product the customer segment we handle is slightly different from those going to the banks. Whereas what our customers expect is a quick turnaround time. They should not miss their day's wage, etc. That is the type of customers we have, and we cater to their need of meeting their time requirements. So even though the competition will be there, but we expect because of the facilities like online gold loan, doorstep gold loan, etc., we'll be able to protect the customer base.
Okay. In terms of cost of funds, what is the cost of funds currently? What's the outlook? And does the RBI ruling impact your cost of funds in any way?
Yeah, the cost of funds now is around 8.5%, and we expect 20 points bips growth as far as the borrowing cost is concerned. That is the expected increase is around 20 bips. More than that we don't expect.
What is the yield comparison between gold loans and non-gold loans?
Yield for gold loan is around 22%, and non-gold yield is around 19%.
Okay. Mr. Nandakumar, I just want to understand, your yield is more than 20%. Banks are giving it at the low teens. How does this work? I recall in the past you had done those teaser rates which pull back a little bit. At that point of time, it was, you're looking at the growth. Now that is done and dusted, but how do you position yourself going ahead? Because otherwise it gets very, very competitive, right? The yields are so high for Manappuram, even in comparison with your closest competitor from the gold finance space itself. So, I mean, give us, how do you think about it?
See, our average ticket size is around 3 months, and the duration, and the ticket size is around 50,000. 50,000, for 3 months. What the customer is looking at is the quick turnaround with regard to the pledge time as well as redemption time. That saves is 2 days. That is most important for the customer, for our customer. So, so naturally, our OPEX, because of that manpower requirement, everything will be higher. So the OPEX remain high, and that is being passed on.
Okay. All right, Mr. Nandakumar, we'll let you go on that note. Thanks a lot for joining in. Appreciate your time here on CNBC TV18. Well, that is Manappuram Finance on the business as well as the way forward. The market is very quiet, but there are plenty of stocks actually that are hitting fresh highs. So just keep an eye out on that. In the broader markets, you have something like a Mahanagar Gas that's piling on the weight now, fresh high over there. It's gained about 40% this year, Mahanagar Gas. It's coming back in a big way. And TVS Motor is another stock that I'm looking at very closely. Fresh 52-week high on TVS Motor. Remember, Ola Electric will be filing its DRHP on the 20th of December. So the Ola Electric IPO is expected to come out, and it's closest competitor in the electric two-wheeler space is TVS Motor. So this stock will definitely be in focus around that as well. Let's slip into a quick break. On the other side, we'll connect with the management of DOMS Industries and India Shelter Finance Corp. Both the companies move a step ahead to their Dalal Street debut. The IPO is open today. More on that in a bit.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC-TV18, embarking on a quarter-century of excellence.
Okay, welcome back. 10 points lower on the Nifty, so not very much going on at all in the secondary market, but there is a lot going on in the primary space. We've got IPOs coming in thick and fast. And this one, the next one we're talking about, is generating a lot of interest. DOMS Industries is 1,200 crore IPOs opening today, of which 350 odd crores is fresh issue and 850 crores is via an offer for sale. The company plans to use the IPO proceeds partly to finance a new manufacturing facility and to expand their production capabilities. Santosh Rasiklal is Santosh Rasiklal is Managing Director, and Rahul Shah is Chief Financial Officer at DOMS Industries. Both are with us here in our studios to tell us more about the company, the business, and of course the offering. Gentlemen, great to have both of you here.
Thank you for having us here.
Appreciate it. You know, as we were just discussing in the break, all three of us are pretty familiar with the product because all of us have kids, varying age groups who use the product quite frequently. So we're talking about pencils, which is the largest kind of component of the business. There is stationery, and then there is art supplies as well, all branded. Just tell us a little bit, Santosh, about the market itself. It would seem that, you know, it's a pretty competitive market out there, right? What is the opportunity? What is your market share in each of these segments? And where exactly is the focus out of the three?
So I would like to start here with, thanking our, consumers who are mainly kids and young parents.
Yeah.
Sir, here I would like to say that DOMS has an elaborate category split where we have our category which are scholastic stationery, scholastic art. We've got one category which is kits and combos. We've got a category which is like hobby and craft. We've got a category of office. We've got a category which is paper stationery. So we've got all all interesting categories in place. Of course, if you really observe and deep dive, each categories are one of the, I think one of the important categories to have for a child today. What we have been doing here is we have a very highest level of R&D approach here in the company. So if I take you through a little bit of our journey, where almost 30 years of our business was OEM. And what we always say that this was not an OEM business. This was a meditation we did, for our product development and for our business. So through this particular experience, we've been able to bring in the product line which are probably much beyond the expectations of our
When you say
consumers
OEM,
today.
you meant you sold to businesses
So
directly.
we were catering to good brands of India,
Right.
and after 2005 we decided to enter into our own branded spree, and this is where DOMS brand got discovered.
Absolutely. I think all of us are familiar with DOMS, right? And I must say you're a big hit at parties, you know,
Yeah.
kids' birthday parties. In the last 5 years, all the return gifts are DOMS stationery in some form or the other. So it's good to have you here in the studio. But I want to talk a little bit about growth. Rahul, come in on this. 2 years back, I think in FY21, you were sitting on about 400 crores of revenues. In 2 years, you went from 400 to 1200 crores of revenues by the end of FY23. What is the game plan over the next couple of years? What kind of growth rates are you guys looking at?
So, ma'am, if you see, historically, since when we launched DOMS brand, we've been growing at a continuous healthy space, both in terms of revenues and margins. FY21 and 22 were slightly impacted years for us, considering the COVID. Most of the educational institutes were non-operational, shut. But I think we could say that FY23 was a result of much of the pent-up demand in the market, opening up institutions, which helped us to achieve this number. But we recently reported our H1 numbers, where it's more of a normalized period. Our H1 sales was about 760 crores with an EBITDA margin of 16.7% and a PAT margin of about 9.7%. So this is more of a normalized period.
But when we talk about growth rates, is it a 15% growth, 20% growth that you can reasonably do over the next couple of years?
So, ma'am, our growth is, more in terms, our growth comes from more in terms of how much fast we are able to add capacities. Today, as a company, we've been, doing a lot of Capex.
Okay.
In the last 3 years, our collective Capex has been close to about 175 crores.
Okay.
Recently, we've acquired a 44 acres of land parcel in Umargaon, where our main manufacturing units are installed. Here we plan to start operations, construction of these buildings in January 2024.
Okay.
And the first, out of the 4 buildings that are planned, first building is likely to be operational by, with machine installation by October 24 and operational by in the next 12 months.
Okay, got it. All right. Hi, gentlemen. Thanks so much for coming down to our studio. Well, let's focus on a couple of these numbers now. You're roughly doing on an average 12 to 1300 crores on an annual basis. Obviously, the first half of the year has been pretty good. But at optimal levels, what kind of revenues can you do? Point number one. And you'll have raising close to 350 crores that goes back to the company. And part of that is going to be used for expanding capacity. How much are you all spending? And what is the asset turn? What I'm trying to get is, what is the potential revenue post this Capex? Please go ahead.
So what we have been extremely and utmost conscious is about how we are doing our asset and with our investment. So
Yes.
historically, you will see that we have already been at an asset turn of 3x plus.
Okay.
And we believe that ahead we would also focus on maintaining this asset turn of 3x plus. This is something which we are right now very conscious about.
Okay.
In terms of numbers, I think, as a company, we've always believed that how we, as Rahul Bhai said, that, how we, increase our market share.
Okay.
And that is going to be extremely, I think, our agenda and our aspiration.
So out of this 350 crores, how much are you all spending on the new capacity?
Yes, we are going to spend 280 crores.
280 crores and asset turn of around 3 times is what you're saying. So roughly around 800 crores approximately is what you can do from this investment at peak potential?
So basically, this entire new project is about 450 crores.
Okay.
The land for this project has already been acquired for approximately 73.5 crores. 280 crores is something which we are going to raise, and another 100 odd crores will be spent from internal accruals. So the total project is about 450 crores.
So you can effectively do 2,200 or 2,500 crores at peak levels, including this Capex, or is it more?
So, sir, as of now, the more commitment is towards the asset turns and also towards the achieving the market potential, increasing our market share. So I think, this is something which we are very conscious about right now. Of course, going forward, once we are very closer to our business plans ahead, we'll have more interactions.
Okay. Absolutely. Rao, just a quick word in on, so the most important category in stationery is pencils, right, for you?
So scholastic stationery definitely is the largest category with about 46%
when you say
of
scholastic
sales.
stationery, it means...
Means pencils, erasers, sharpeners, scales, mathematical boxes, out of which the single largest product, out of so many products is wooden pencil, which is about 32% of our sales.
Overall sales.
Overall sales, yes.
Are there any other adjacent categories, pens, etc., where, you're already present, you're kind of expanding into?
So yes, like if I have to say, the other key product categories that we have is something like a mathematical box. We have a very wide range of art material. We've gained a significant market share in this segment also in the last few years. Plus paper stationery, we entered this company through this business through an acquisition that we did in 2015. Today, this category contributes about 10% to our total sales. Kits and combination packs, like you all are aware, that's something which is doing really well. It's about 9% of our sales today.
I have a couple of...
Sorry, I would just like to highlight here that the paper stationery business, we entered this company, Pioneer Stationery, when it was at a revenue of 4 crore. We have in 2023 done around 138 crore from this business. And possibly we have been able to be a pan-India brand, for this particular category.
Just one, just to complete that point, what is the sort of, in a way, what they call moat for the business? What is the big, is it a brand? Because it's a very, in a way, it's a very crowded market, right? There's so many other players, etc. You're a strong player with a strong recall. Or is it distribution, or is it lower prices? What is it that will help you grow and defend your share, in your opinion, Rahul?
So it's a combination of everything. First and foremost, we always consider, our product are our hero. They are a real celebrity. So we focus a lot on product development. Since the time we launched the DOMS brand, the idea was simple, that any product that comes out from the DOMS umbrella has to have something in it which connects to the consumer. So we focus a lot on product. This comes from our focus on R&D, where we have 50+ strong team members who are working in development and designing of the product. Then is definitely our manufacturing infrastructure. All these categories, almost 25+ product segments, all are manufactured in-house. We don't believe in trading as a business. Everything we manufacture in-house, and at the same time, each of the product is completely backward integrated. Today, if you talk about pencil, every component that goes in manufacturing of a pencil is something which we manufacture in-house. Similarly, across all our product categories. And last is the brand, and the strong pull that we are seeing from the brand. Our consumers are loving the brand.
Absolutely. There's no questioning that. Just a couple of concerns before we wrap up. One is your export contribution has gone down. A couple of years ago, it used to be 25% of your business. Now it's less than 20%. Are you facing any major pressure there, and do you plan to bring it down further?
So, ma'am, two parts to this answer. First and foremost, in the initial years, FY 21-22, you'll see the percentage of export being a little higher, purely because the Indian education system being shut, demand in India was less, but export markets were still open. But over the years, our export has been close to that 20% mark. And our focus has always remained on the domestic market. Today, our, enhancing the DOMS brand, fulfilling the requirements of our domestic market is something which is utmost importance. So, we will continue doing that. We'll focus on the domestic market to enhance our sales.
Okay, all right. We'll let you go on that note. We have many more questions, but I think we'll leave it for another day, perhaps closer to the listing.
Thank you very much.
Listing.
Thank you so much.
Thanks a lot.
And thank you for, providing so much for our children, right? Our children love your products. So
Thanks.
Your main consumer. All right. Well, let's do one thing. Let us take a quick commercial break on that note. Lots more coming up on the other side of the break. But, okay, we have another IPO. There's one more IPO issue that's coming through today. India Shelter's 1,200 crore rupee IPO is opening. So let's get the management in. Of this 1,200 crore fresh issue, 800 crores is a fresh issue and 400 crores is an offer for sale. The company has raised 360 crores from anchor investors, Rupinder Singh, the MD and CEO, and Ashish Gupta, the Chief Financial Officer at India Shelter Finance Corporation, join us now to talk about that. Gentlemen, morning to both of you. Mr. Singh, let me start with you first. If you can just, for the benefit of our viewers, people who are perhaps looking towards your IPO, tell us a little more about your business. What kind of growth are you looking at? What kind of asset quality are you targeting over the next couple of years? I think you're on mute, Rupinder. Yeah.
Yeah, very good morning.
Go ahead.
And thank you for calling me on my channel. So we got the anchor book yesterday. So good names like Goldman Sachs, ICICI, Nippon, Kotak, Axis, TD International, all supported us in this piece. Now the issue opens today, and we are quite positive. And thanks to all kind of support from entire ecosystem. So if we talk about the business per se, the India Shelter Finance Corporation started way back in 2010. We are into this same operation from last 13 years. It's a housing finance company, purely housing finance company with a focus on affordable side. We largely capture tier 2, tier 3 markets for the affordable, and our focus remains on self-employed. So category of customer where the income is between 25,000 to approximately 55, 60,000, and the average ticket size for loan remains around 10 lakh rupees. So this is the focus area. And when we started, those were the days for home loans, which are more into prime segment, towards more on the salaried side and the creamy layer of society. At that time, we played this punt, and I think giving good fruits till now. It's working well for us.
Can you just tell us a little more about your customer profile? What is the EMI to income ratio that you have on your customer base? And what is your game plan? I mean, are you looking to stick to this customer profile, or are you looking for any kind of change, diversification, etc.?
So this customer profile, majorly you find the markets where you operate into that. If you see the EMI to income ratio, normally it is around 50 to 55% where we offer these loans. In fact, one more important piece that we keep in mind, apart from this ratio, is the loan to value. That is again the collateral what the property has been offered by the customer. So we have 50 to 53% of loan to value there altogether. And this is helps in terms of controlling risk also, because a lot of equity from customer side also comes into to play the role out here.
All right. Good morning, Mr. Singh, as well as Mr. Gupta. And thanks so much for joining in on the show. Well, with this fundraise, will you be pushing for a rating upgrade? Point number one. And how does it change your CRAR?
So our business is all about three important pieces. One is money, which is a capital, raw material for us because of finance business. Secondly, the people who drive the business, that's a team around there altogether. And we also blended a technology around there. So today, the net worth, as we see the September number, is around 1,375 CR. With this infusion of 800 additional number coming around, we will cross the level of 2,000 crore plus capital, and that's an important benchmark to have if we have to look for the next level of growth. Obviously, when we had to go to banks for next level of borrowing, we can request rating agency for upgradation also, as we stand today with A+. So this is an opportunity lies as you increase the capital. Housing finance company normally have a very strong CRA, and just because risk weightage is quite strong, thanks to the regulator in terms focus around that side, consider to be a less risky profile around that side. So more focus is always on the leverage side. So if we see the leverage particularly, it was 3.5x when we see the September number. With this infusion of fund, it will definitely go down. But the objective is another 12 to 18 months, we should come back. So that is a thought.
Mr. Singh, good morning. Mr. Gupta, good morning. Mr. Singh, just what you said, self-employed, the affordable side, right? That's the target segment for you.
Yes, absolutely. And that also will be a
Right. We had the management of PNB Housing yesterday with us, and they're also focusing on the affordable side. And we were discussing the supply there, and he was telling us that most of the affordable housing is, only 20% is new construction coming up. The rest of it is resales and people constructing their own houses, etc., etc. Would you concur with that? And does that pose any risks higher than if, say, for example, it was more organized in that sense?
So India is a vast geography we see. So today we are operating in 15 states and more than 200 branches. So deeper you go, the aspiration of building house is coming up thanks to the good schemes like Pradhan Mantri Awas Yojana and support from government in that side. So a lot of awareness is now which is coming up, which was not there say 10, 12 years back itself. So we are targeting deep into markets. The segment of customer where the ticket size itself is around 9-10 lakh rupees. It's a very low when we compare to the large institutional banks who try to cater the requirements majorly in the top 20-25 cities. So if you go to smaller places, we are the locations which most of the people may not be aware of today, but still they have a strong population. The growth is coming around at least. And if we see our record of last 4-5 years, there's a consistency in growth. The CAGR of 40% we are constantly giving around. And the way we are seeing the traction in marketing in recent time, we find that there's a lot of opportunity on that side.
What proportion of people who borrow from you, Mr. Singh, borrow it to build their own houses?
Almost 25 to 30% are for the self-construction. Then there are remaining 20-25% who will the sale purchase. Then there are around 40% who will go for loan against property also because they're into mortgage the same kind of business. So these are the three aspects.
Okay, Ashish Gupta, who's the Chief Financial Officer, is also sitting by with us. Ashish, Rupinder briefly mentioned loan against property, so I want to talk a little bit about that. Your LAP book is currently at 40%. Do you think this is a high risk for your business? I mean, because it may have a high amount of unsecured book as well, or do you consider this as an opportunity?
So we have, we have 40% LAP book, but the kind of discipline we have maintained, in our underwriting processes is pretty much similar as we have done in case of housing loans. So, if you look at our LTVs of LAP is around 45% average, vis-a-vis home loan around 55%. So it's a less riskier product as compared to home loan, though there is a difference in the end use, where in case of housing, the money goes for, for the purchase or for the construction of houses. But in case of LAP, the money goes for the business. So given the, our conservative underwriting processes, wherein we always keep self-occupied property of the borrower as collateral, we think that it is as good as home loan.
Okay, so you're not facing any issues with respect to repayments, etc., from your LAP book, right, at the moment?
If you see our historical trend of delinquency in the LAP book, it is pretty much similar as the home loan. So our delinquency, our GNPA number is at around 1% total. And in case of home loan and LAP, it is pretty much similar.
All right, final question then before we let you go. What about geographic spread across the country? How do you see that changing, say, in the next 2 to 3 years?
Actually, the 15 states which you cover, that covers almost 90 to 94% of the mortgage market of country. So there is a lot of scope. We are just 200 branches in 15 states. We are not even have covered the entire districts around that side. So going forward, we'll see a lot of penetration in these markets in terms of opening new branches, tier 2, tier 3 and beyond that. Because as the confidence kept building and our also say if the geography keeps increasing in form of distribution and strengths. So you will see a lot of traction in terms of opening new branches. So we expect 35, 40 branches get added every year if we see the next few years going forward. In these particular 15 states, we're still operating.
Thanks so much, gentlemen, for joining in and giving us a sense in terms of how you see things shaping up. We're looking forward to the listing, and then we'll have a deeper chat. We'll get some, guidance as well in terms of the way ahead. Well, when we were having those chats with, both those two managements, well, the markets have moved to the low point of the day. The 20,850 odd level, that's been the level that's held out for the last few sessions. The crucial support is at around 20,700 to 20,850, but the markets have moved lower. The Nifty bank as well is down close to around 200 points odd, and there is some selling. I think you pull up both the indices. The banking index has moved lower, and the IT index as well. You have a couple of stocks in there that has seen some selling. TCS is now down close to around 2%. Get the IT index up for you on the screen. Mitesh Thakkar is back with us. Mitesh, we're down 80 points, holding at around 20,820. Where does support come in at? And fill us in with your fresh trades.
Yeah, so I think on the index, this looks like to be some kind of a pullback going on. I think 2,700 is the level which I would, consider as a important support area. This entire rally, which started from 18,800 to about 21,000, maybe now getting into a consolidation of pause kind of a mode. And if we hold on to 20,700, I think we'll just see a sideways action and then possibly a continuation. So for the time being, looking at 20,700. On the stock side, I have a buy on Hero Motors. Disclaimer, we have recommended this to our clients, so there's vested interest. That's a buy with a stop below 37.50 for targets of 3900. And a buy on Chambal Fertilizers with a stop at 352, buy for targets of 366.
Okay. Mitesh, coming back to you for more. Thanks for those trades. Canfin Homes is up about 1.4% or so. And it's had a bit of a rough ride, right? Up and down, but more up now. So the stock fell, remember, 13% in 4 days on fears of fraud in one of their branches. The Canfin management yesterday clarified on CNBC-TV18, said that they've carried out a check at all their branches and that there is no incident of fraud in any branch other than the Ambala branch. Morgan Stanley, has written a note citing CNBC-TV18's interview from yesterday, and they are, while citing some downside risk to their own forecasts, they maintain an overweight rating, essentially saying that valuations actually seem to be still very attractive. So that is Canfin Homes in focus. Just a quick word on the Nifty. We are below the... so in the morning, we were talking about how it's an open question mark, whether in the very near term, the move is maturing. The up move is maturing. And 2850 was the support, which we've been highlighting the last couple of days, is the recent low. We are below it. Yesterday, we did not break it even intraday, but today, right at the word go, at least in the first hour, we are just under it. What will matter, of course, is a close one way or the other. So we will watch out for that. 1/3% down after yesterday's near 0.5% cut. We'll take a quick break here. Commodities in focus. Manisha comes back with what she's watching out for. Stay with us.
CNBC TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
All right, let's shift focus now to the commodity markets. Manisha Gupta is standing by to tell us what's on her radar. Manisha, over to you.
Sonia, thank you for that. I'm looking at the crude oil prices where we have seen 4% of a decline in the overnight market, so that the prices are now trading at around 5 to 6 month lows. 4% down overnight, and we are down 12% now in the past 1 month when it comes to the crude oil prices. Well, the US inflation data that has come in is now bringing in a probability of absolutely no rate cuts in the first quarter of 2024. I mean, that was a number that the markets were leaning on way too much, and that is out of the scene and is the reason you have seen that premium go off to the markets. So we are trading below $70 a barrel for the WTI crude and below 75 right now for the Brent crude prices also. Also, when you look at the OPEC and allies output cuts, since the kind of discord that they have, and this is something that the markets have been factoring in case of prices, that there could be still surplus in this quarter and the next as well. Add to that the EIA data that suggests that the US output will continue to grow as we go forward. So 12.93 million barrels per day in this year and a higher 13.11 in the next year, which is an all-time highs. Also, markets are looking at record productions not just in US but in Canada and Brazil as well. So the non-OPEC crude output is expected to continue to grow in the next year as well. Even as there are concerns about Yemen Houthi attack on Norwegian commercial tanker, but the markets are in no mood to take in any risk news into the prices right now. It is all about lower demand, higher supplies, and which seems to be putting pressure on prices. EIA also says that they are now downgrading the Brent projection in sense of prices for the next year by $10 to $83 per barrel of an average for the next year. And that's the kind of statement you have seen come in from various other agencies as well. S&P Global is another one which says that 2024 demand estimate is down by 1 million barrel per day versus the supply growth. So you are looking at a surplus going forward into the markets. It also is about a lot of data watch that the street will watch out for. To begin with, it's going to be the COP28 negotiation that the markets has an eye on, which is still awaiting a new draft deal on phasing out of fossil fuels. And then it is about OPEC monthly report that comes in today. And most importantly, the US Fed meeting announcement will give direction.
All right, let's take a quick break on that note. Thanks a lot, Manisha. On the other side, our special segment, it's the economy. Lata will connect with Ashish Agarwal, the Vice President and Head of Public Policy at NASSCOM, and Gaurav Karnik, the partner and real estate leader at EY, to decode opportunities in commercial real estate space after the Commerce Ministry amended the SEZ regulations. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome to It's the Economy. The Commerce Ministry has recently amended the SEZ regulations to permit demarcation of a portion of the area within an SEZ unit as a non-processing or a non-SEZ area. The regulations specifically address this easing of rules for the IT and the ITES sectors, infotech and infotech-enabled services. So, how will IT companies benefit? How will the economy benefit? And indeed, why these change of regulations? For all this, I'm joined by Ashish Agarwal, the VP and Head of Public Policy at NASSCOM, and Gaurav Karnik, Partner and Real Estate Leader at EY. Gentlemen, thank you very much for your time. Well, let me start with you, Ashish. Where was the need to change these rules in this fashion?
So if you look at in this series of reforms, so now it's a good time to look at, how can the developer community and as well as the ITS industry get a little more flexibility in terms of how they utilize that entire space. And I think the overall intent is to say that there is this infrastructure and how we can maximize its utilization. So what this particular notification is trying to do is to say that, look, if you want to be in the non-processing zone, then you can be, and that can be done through this floor-wise demarcation. And so, in a way, it's a good step. What it allows people to think about is to say that, look, if we don't want to, let's say, if we feel that the compliances on the SEZ is something that we don't want to necessarily continue to have, then we can think of being into a non-processing zone. And ultimately, I think it gives the developer the flexibility to organize his setup.
Okay.
But I think there are a lot more issues which are related to this that I'm sure we can discuss.
Sure. Gaurav, first thoughts from you. Who were the people who were asking for this? Was it GCCs? Was it IT companies? Was it real estate? Which kind of industries benefit?
So basically, the whole issue was that developers who had built this SEZ, world-class infrastructure. Since COVID-19, one thing, the work from home whole thing, and also GCCs who wanted to come to India, like Ashish just mentioned. The tax benefits to the SEZ have been phased out. Okay. So what was coming for the new players was that you had world-class infrastructure, but along with that you had a lot of compliances. So there was a demand from units that who had to the developers that we are happy to come into the SEZ because you have great infrastructure, but the whole compliance makes us hire these compliance teams, which adds the cost. So that resulted in a lot of vacancies in the SEZs. There's nearly 170 million square feet of SEZs in the top 6 cities, out of which nearly 30 million is actually vacant right now. So there was a long-standing demand of the developers really that we should be allowed to arrange our SEZ in a way that we can use up the space, because there's great infrastructure which is just lying vacant, and it doesn't make sense for it to remain that way.
Okay.
And from a government perspective, you look at it by allowing the developers really to lease out the space or have it denotified. It gives them excess revenues because one, you get rental GST, you get employment because new GCs will come in and set up shop here, will employ more people, and therefore they will result in more income tax as well. So from a government perspective, also it made sense to allow this flexibility.
Okay.
Because it is revenue positive.
Got it. Ashish, who benefits? Is it developer community or is it more ITES or more GCCs? Which is the largest community in these SEZs?
So in the SEZ, you'll find the IT services and GCCs both. So it's not, they are very well there. And overall, 60% of the industry is in a way in SEZ. So that's a good way to look at this.
Okay.
So I think this is intended to benefit both the developers and the units. But I think the point is that, the only thing which is doing is that it is making you, giving you that option that if you have transitioned out of the tax holiday and then you are still looking at these compliances, so this is the next step to say that, okay, you can actually, go into these non-processing zones. And similarly, if you look at from a developer point of view, if there are certain even new areas in SEZ where you have not constructed the building, where you just have land and you feel that you just paid the stamp duty and now you no longer want it to be to use that SEZ format, then instead of going for the complex denotification process, you could just use this. But I think one of the things which we will need to see in order from an overall reform perspective is that there are other elements like allowing INR billing. So, if once that also comes in, then I think combined with this, I think it starts giving a whole set of options to the units.
But has it not allowed? INR billing is not allowed. I thought that if in a particular building, an IT company uses, say, top 2 floors for dollar billing, and the others are denotified, they would be for rupee billing, wouldn't it? It doesn't go without saying.
Yeah, no, you're right. All I'm saying is that you don't have to necessarily go for demarcation only to take the benefit of INR billing, right?
Okay.
So I think INR billing is a request which is there for even when you are into the export processing zone.
Okay.
So I think right. So when you see that as a reform, which again we expect, and then you also see this option of demarcation, then I think it creates a full picture in terms of ease of doing this.
Oh, yes. I'm an RBI reporter for a better part. And yes, that's very much something Reserve Bank is pushing, rupee billing. But Ashish, just to complete the point, how much do Indian IT companies benefit? Like, for instance, would it mean a lot of gain for a TCS or a Infosys or a Wipro? Are they predominantly in SEZs? And does this add to their margins immediately?
So see, a lot of the large enterprises are big time into the special economic zones, and some of them are also developers, and they have their own, buildings and units. So from that point of view, if they are at the end of the cycle of tax benefits, then it makes sense for them to review and say that, it makes sense for them to, whether it makes sense for them to move into a non-processing zone. But I think there are a couple of things that we are still looking as a clarification. For example, you need to repay the tax benefits that you have availed. Oh. And yeah, so that calculation, that maths has to be done. And also it is not that you have to repay the tax in terms of just the amount of tax benefit that you have utilized, and some bit of, is there any bit of concession in that? You actually have to repay the entire tax that you have taken as a benefit. So from that point of view, I think that is still a working that industry is doing to figure out whether it really makes sense for them to do this.
No, but if they are already completed their phase of within the SEZ location, their export commitment, do they still have to pay back? After all, during that period, they could avail of the tax benefit. If they denotify now, after the period has ended, even then they have to pay back taxes?
May step in, Lata, the way the circular is that basically it does with the developer of the SEZ. Now, when the SEZ was built up, they took the tax benefits for both the processing and the non-processing area.
Okay.
So now when you make a processing area into a non-processing area, whatever fraction it is basically a proportionate amount of tax benefits that you take to the extent of the non-processing area that you have to pay back.
All right.
The issue comes with how do you calculate the value?
Okay.
Because it's not given that you get depreciation on the building value.
Okay.
So it has to be certified by a chartered engineer. So there will be some work around that how is the valuation of the building to be done, so as to get the correct amount of taxes which they have to be paid back.
Okay.
And also with regard to common infrastructure will now be used by both processing and non-processing. You will have to pay back the tax benefits you used when you build this up. So that's how it is. That's how the circular, the notification has come out.
Got that. So immediately, Ashish, we cannot calculate, there isn't any immediate margin benefits flowing to IT companies?
So it is not something that is immediately apparent to say that, units are immediately taking a decision that they are now going to take this particular step. And given the fact that developers, the IT units who have the entire, who are also developer, then for them, it won't be a case of trying to, do a partial demarcation.
Okay.
Probably they want to look at the full thing, then those costs become more relevant, right?
Okay. Okay.
Yeah.
Well, to come to you, Gaurav, there are no immediate beneficiaries then? It's all waiting for the rules to come out?
So I think the rules are, the notification has come out and, people are already started to work back with the development commissioners and they will be putting in applications for denotification. A number of the listed REITs, they have a large amount of SEZ space in which currently they have vacancies. So let's say in the next 2-3 months, they do get the denotification. I'm sure they're going to attract, more tenants. So I think there is going to be an upside in the next 6 months for most of these listed REITs for sure, because at least the vacancies will come down. You'll have more leasing income, which should improve the yields on the REIT.
On the REITs. So the REIT guys are the first beneficiaries, not any of the... Sorry, go ahead.
And the larger developers, like, we have the large listed companies who also have SEZs who are not necessarily REITed, but they are listed on the public stock exchange.
Yeah.
So they will also have the same benefits coming in.
Yeah, we did speak to both MSC REIT and DLF earlier. So those two are clear beneficiaries, but not any directly the IT companies, Gaurav?
So IT companies, like Ashish said, that has to be worked out how that works. That are they the new ones who will come in? Mostly are the new units who are going to take benefit of this non-processing area, or is the existing ones? Because then when the existing ones move out or get re-notified, they have to return back also the tax benefits.
Okay. So
that working has to be done to see how that impacts their bottom line.
Okay. No, I sense that because the stocks didn't immediately move after the deregulation. So I just wanted that clarification for the larger body of investors who are watching you. Gaurav, what would be the, Ashish, what would be the broader advantages? More GCCs would be attracted because this is counting as ease of business in India?
Oh, definitely. So if you just look at it from the point of GCC itself, roughly 40% of the global market is still to be established in India. So there's a huge appetite. And we have seen over the last year that growth really, also gain more momentum. So from the overall industry growth perspective, I think it's a world-class infrastructure, and these are in good places, good locations. So I think people who don't want to get into a lot of SEZ compliance, and obviously the tax holidays are gone. So net on that front, it's quite a good move.
Okay, and just a final question to you, unrelated to the SEZ regulations, Ashish. What is the mood among GCCs? Since we are seeing fears of a slowdown in US and already some softness in Europe, are GCCs, not expanding that quickly or not setting up new units? Is there any kind of hesitation or slowdown in the September to March period?
So I don't think we have an outlook for September to March period specifically, at least I don't have that. But I think overall there is already a pipeline in terms of the work from a GCC perspective. And given the fact that it's a fairly related party kind of a construct, I think, and from an India point of view, I think there are no immediate concerns. So I think as long as it is business as usual, we are seeing that growth.
No, that's true. I agree for existing ones. What I mean is that people who are wanting to set up a GCC, is that pipeline reducing at all because of this feared slowdown?
So at least we are not seeing that in any manner in the GCCs.
Okay, well, I just thought I should use if NASSCOM is with me for the larger question as well. Thank you very much, Ashish and Gaurav, for improving our understanding of this ease of doing business by the, kind of a deregulation in the SEZ regulations. They can demarcate a part of their land as non-SEZ purposes, should be beneficial for the REITs and the developer community immediately and in the long run for IT and GCCs as well. Thank you very much for watching this special edition of It's the Economy. After a break, it will be time for Chartbusters.
CNBC-TV18, embarking on a quarter century of excellence.